Major credit rating agency just downgraded the US government from AAA to AA+, and they predicted a recession at the end of 2023 and the beginning of 2024. We're going to talk about exactly what they said in that report and what it means for me and you as individuals. But first, before we get into that, I'm glad you're here. I'm Austin. I'm a co-owner of cloudmusicweek.com. I'm a stock market investor. Channel's sitting somewhere in the 1,600 subscriber range. If you're back and you're one of those people, thank you so much for being back. If you're new, go ahead and click that subscribe button. Drop a like for me. It seems to help out the videos a lot. And so thank you for doing those two things. Here's a picture of both my cats, Millie and Luna. Millie's the gray one, Luna's the brown one. Thank you for subscribing. Okay, let's get into it. Fitch, which is a credit rating agency, just downgraded the United States from AAA to AA+. So the summary of their report says the rating downgrade of the United States reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA and AAA rated peers over the last 2 decades that has manifested in repeated debt limit standoffs and last-minute resolutions. Hard to disagree with anything there. If anyone checks in on the macroeconomic health of the United States and checks out government debt numbers on a regular basis and listens to the news, they would probably agree with this paragraph right here. So it's hard to argue with the rating downgrade summary, and this is probably way overdue, but due to the pandemic a few years ago, not only the US government, but governments around the world as well, got a ton of grace as it related to running their fiscal policy absolutely disgustingly horrible. A lot of decisions were made in the short term that are going to have long-term lasting effects. One of the big reasons for the downgrade was the general government debt to GDP ratio. From their report, they say lower deficits and high nominal GDP growth reduced the debt to GDP ratio over the last 2 years from pandemic high of 122% in 2020. However, at 112.9% this year, it's still above the pre-pandemic level of 100.1%. The general government debt to GDP ratio is predicted to rise over the forecasted period, reaching a whopping 118.4% by 2025. And then this is the crazy thing. The debt ratio is over 2.5 times higher than the AAA median of 39.3% and the GDP of a AA median rated country at 44.7% of GDP. And then they go on to say Fitch's longer term projections forecast additional debt to GDP rises, increasing the vulnerability of the US fiscal position from future economic shocks. The government and the Fed specifically coming in and doing quantitative easing and increasing the money supply every single time there's a little bit of economic trouble is putting the US in a terrible, terrible spot in relation to its peers. Every time there's a US macroeconomic issue, the government comes in and tries to save the day. They want to reduce the amount of pain that we're feeling in the short term so that we can keep up our standard of living as Americans. But in the long term, this is not going to lead to good outcomes for the United States unless we start to shrink the balance sheet and continue doing QT, which is quantitative tightening and decreasing the assets on the Fed balance sheet. So here's the first way I make sure I'm not freaked out and losing sleep over potential currency crisis. Check out this comparison from 1970 until today that compares gold price to US total public debt. We can see that US total debt reached $30 trillion around the same time that gold reached $2,000 per troy ounce. So what I do is I ask myself, what percentage do I feel like there is a currency crisis in the United States? Is it 1% I believe it could happen in the next couple of years? Is it 2%? Is it 20%? That is the percentage of gold I have in my portfolio as a whole. Since I believe that percentage is pretty dang small, around 1 to 3%, when I take all my assets, I want to make sure that gold is somewhere between 1 to 3% of that. I'm not overly worried about my entry price on gold. I'm not overly worried about where the gold price is whenever I buy more. The lower the better, of course, but I understand that the relationship between gold price and US debt is going to continue. So as we move to 40 trillion, 50 trillion, 60 trillion, which is probably going to happen over the next few years, or hopefully the next few decades, there's a high probability, based on the correlation in the past, that the gold price is going to increase with that, and I'm going to be protected in that way. Even if equities have a rough time as we see some economic weakness in the US economy over that time. The other thing I want to talk about from this Fitch report was that they say the economy is going to slip into recession. Check it out. Tighter credit conditions, weakening business investment, and a slowdown in consumption will push the US economy into a mild recession in Q4 of 2023 and Q1 of 2024, according to Fitch projections. That's a big statement. I've heard other people say that as well. Fitch is not the only agency saying this, but they're saying we're going to see US annual real GDP growth slowing to 1.2% this year from 2.1 in 2022, and overall growth of just 0.5 in 2024. They're saying job vacancies remain higher and the labor participation is lower than pre-pandemic levels, which could negatively affect medium-term potential growth for the US economy. Of the three things they mentioned, I'm the least worried about a slowdown in consumption in the United States. The United States is great at consuming things. We're great at keeping our quality of life the exact same, even if it's to the detriment of the finances of the family that's purchasing those things and consuming those products. Definitely not a good thing, but I do see consumption probably staying pretty much flat. That said, weakening business investment. I've seen multiple companies report earnings who originate loans to businesses. This could be small businesses, this could be mid-sized businesses, or this could be big businesses. The commentary across the board from all those companies is that they're seeing a slowdown in the debt that's being taken out by companies. This is probably because they don't want to pay these insanely high rates that we have right now. We got a Fed funds rate around 5.5%. That's over a 22-year high on the Fed funds rate. So do I agree that the economy is going to slip into recession Q4 2023 and Q1 2024? I could totally see it happening, especially if we have any more rate hikes and if the Fed keeps the rates at these elevated levels for a substantial amount of time. I could see a recession. I don't know. I don't have a crystal ball, but I can see a scenario where we might get a recession Q4 2023 and Q1 2024. As the individual and as the investor, the only things I'm really going to change there is one, I'm going to personally make sure I'm maximizing my income versus expenses in my own personal finance life. I'm not going to be a major consumer in these times. Two, I'm not going to take out any consumer debt. I'm definitely not taking out personal loans. I'm definitely not paying any credit card interest right now. Three, I personally won't be buying any real estate right now. And then four, in the stock market, I am going to make sure I'm picking companies that are not debt ridden. I'm going to pick companies that have tons of cash on their balance sheet so that they can weather a potential economic downturn with very little debt and definitely very little short-term debt that's going to be due within that year. I'm going to be increasing my positions with great balance sheet companies with respectable revenue growth, very stable revenue growth, and companies that are massively EPS positive with EPS growing faster than revenues. And on that EPS front, I want to make sure that these companies are profitable from operations, not just profitable from the US treasuries that they may hold. A lot of companies get a lot of interest income, especially in the higher rate environment time. So I'm definitely looking for income from operations, not income from net interest income. Let me know in the comments what you think about this Fitch downgrade for the US government. Do you think it was warranted? Does it scare you? Are you worried? And are you changing anything about your investment thesis or your personal finance life as a result of this? Let me know in the comments below. Thank you for being here and have a great day.